Welcome to our video report. This is Ramesh Sigamani from Bravisa Temple Tree. In this video, we talk about the concerns that investors have on the returns their investments have been making. From the beginning of 2018, from where corrections set pace in our market, there has been a huge divergence in the returns that investors are seeing on their investments. SENSEX moved past 40,000 and Nifty went past 12,000, which were historic moments for both India as well as its investors. While SENSEX kept moving higher and higher, investors did not see similar kind of returns coming into their portfolios. They were more confused as to what is happening. SENSEX is going up whereas my investments are not going up. We thought of doing a deeper study on finding out what is actually happening in the market today. SENSEX consists of 30 stocks which form the larger part of our economy. These are businesses which have huge amount of shares that are in circulation in the market, which also will have very less volatility. This gives the option for people to invest in high sums, that is, big number of shares can be moved in and out without distorting the price movement of the stock. Only a handful of this 30 stocks, not all the 30 stocks that formed the SENSEX moved up when SENSEX went past 40,000 mark. A couple of stocks, are probably a handful of them, kept on rallying and helped the SENSEX reach past the 40,000. Whereas when we see the broad market, it not only consists of this 30 stocks, it has larger businesses, mid-sized businesses and smaller businesses. In 2018, correction was largely hit on the mid and small cap space, where valuations had been extended due to demonetization. Demonetization moved money from physical assets like gold and real estate to financial assets, where huge chunks of money, not only in bulk form, it also came in the form of SIPs. The monthly SIPs that was around 3,400 crores per month in March 2016 has now more than doubled to 8,160 plus crores per month, which means about a lakh of crore is coming into the market as new investments every year. Why only a handful of stocks moved up in price? In 2018, SEBI brought in the recategorization of mutual funds concept, where mutual funds have to hold their exposure only based on their categorization. That is, a large cap fund should have major exposure only to large cap, mid cap fund should have maximum exposure only to mid cap. This brought in heavy selling pressure, where the valuations in the market for mid and small caps were very high in 2017 because of huge fund flows. As there were large chunks of money coming into the market to the fund managers kitty, they were forced to buy those handful of good stocks that were already doing well, thereby pushing the valuation of fundamentally strong stocks to very high levels. This generally happens in the market and it course corrects where valuations get down and get into a right pace. When this correction is happening, the recategorization also comes there and puts artificial selling pressure, which pull down the stock prices to deeper lower levels. Fund managers moved out of large mid and small cap space in large chunks and parked all their money into bigger businesses, large businesses which had high liquidity, though they were not fundamentally strong. Money moved into stocks like SBI, TCS, Hindustan Lever, Reliance kind of stocks which had very high liquidity in the market, whereas fundamentally they were not actually strong to accept or hold investments. For example, if you take TCS has had a growth of around 15% in the last quarter, whereas generally fund managers look for growth at around 25%, 50% plus, which is mostly available in the small and mid cap space. Whereas TCS, though it was having lesser growth, it just kept on attracting money. Fund managers put maximum exposure into these big stocks. That is, as per the mutual fund law in our country, a single stock can only have 10% exposure in the whole portfolio. So fund managers just push all their money into big companies so that they can load all the excess money into these big companies, and later on when they find opportunity in mid caps, they can take out from them without much damage and move to mid cap. So this pushed the stock prices very high. Similarly, TCS, though it is not fundamentally strong, price kept on going higher. Even the valuation of TCS today is beyond the industry average, yet it has been attracting more money and stock has been moving up higher and higher. Similarly, when we take SBI, it is just out of its loss-making streak, which began when the NPA issue struck the markets. Even now, the NPA ghost, or the shadow of NPA, is not moved out of the stock, yet the stock is kept moving higher. In almost all the defaults that has been happening in our country, SBI has a bigger share of losses that is coming up, and yet there are some more bigger names which are expected to announce or get into the default list. So such kind of money moving into businesses like this had pushed the stock prices and moved the SENSEX up. Why broad markets have not picked up pace? If there should be growth in a company's balance sheet, sales has to improve. If sales has to improve, people have to consume. As of today, consumption has been very poor in our country. It is yet to pick up pace. In the March quarter result, what came recently, most of the companies have reported lower sales growth while they have expanded on their profit. This can be possible only if they are cutting down on their expenses. Expenses like salaries and wages could have been cut down, interest expenses could have come down. Also, they would have increased their efficiency in their operations. Interest rates could have come down because of promoters clearing of their loans, which was forced on them due to the insolvency and bankruptcy code that came into effect in our country. Lower growth or lower interest rates also shows that companies are not investing in creating new capacities. This is because the existing capacity itself is not being consumed. When new capacities are not created, growth will not be big. It will be only at a slower rate. Hence, mid and small cap stocks or a broader market is hit on both sides, both on their balance sheet growth as well as huge hammering of their stock prices. How long is this situation to continue? All eyes today are on the upcoming budget that is going to be announced in the next 2 weeks from now. Almost all the industry have started asking packages from the government. Cash liquidity has become very tight in the market due to banks stopping funding to the NBFCs. NBFCs have played a major part in creating consumer durable sales in our country, which is now almost at a stagnant level. Market is expecting some very good news from the government on this space. Next is the expectation on monsoon. If monsoon is going to be well, that will trigger rural income and create consumption. Whereas as of now, this monsoon season, we are running a 44% deficit on the rainfall. So all the thoughts that we have shared here are long-term in nature, where any kind of change in conditions will take at least 6 to 12 months to set pace. By this understanding, it means that markets can revive in the early part of 2020 or in the mid of 2020. Until then, large cap space or the big businesses space is going to do well and rally up. The reason that your portfolio is not been doing well, mutual funds invest into a wide spectrum of the market. They don't invest into a handful of stocks. Even in the big money that has been moved to the large cap space, they have been very selective. Not all the mutual funds are having exposure into those stocks that have run up in the recent few months. That is because of the valuation concerns they have even in that space. In the market, big money is made only from mid and small cap space. Large cap businesses or large businesses give an average return of between 8 to 13% over any time period. In the same level, if you see mid and small cap, it can give anything about 20% and sometimes 40-45% also when the market is bullish. So for any fund manager to take the all the potential that is available in the market on his portfolio, he has to be invested into mid space, smaller space, and also larger space. Only then he can create alpha to his investors. Even if you take the investor alone, like individual investor, there will be very few people who are invested into one category alone, like having only large cap or mid cap or small cap. If suppose there are people like that, those who had invested into large cap would have seen big returns on their investments in the last 15 to 18 months, whereas the same portfolios in the next year will see downside move when fund managers pull out money from this large cap space where they have parked it temporarily and move to mid cap. Otherwise, on a diversified portfolio, say you have one mid cap, one small cap, and one large cap in your portfolio, chances are the large cap exposure totally in your whole investment will be around 25 to 30%. Now you can see the correlation. 30% of your investment is going up because of large cap rally, whereas 70% of your investment, which is in the mid and small cap, is going down, bringing down returns. Thereby, most likely your investment will be in negative territory. So the next question will be, is it dangerous to have diversified exposure? Should I be invested into a concentrated portfolio like one segment or one category? No, it is actually good to be having a diversified investment portfolio. Markets go through cycles. When larger businesses do well, mid-sized ones stay put, smaller ones can go into correction. They take time to perform. If someone had invested into a single segment like what we have today or talking about today on large caps, chances are that they will have good returns at one period. When the tide turns, there will be negative returns from the same asset. If suppose you are invested into a diversified portfolio, it gives consistent returns and has lesser volatility. No doubt the diversified portfolios are today doing badly. That is a one-off condition where a lot of external factors have played in the markets today. One need not worry about the negative correlation that is there between your investment in the SENSEX today. In a year or two, this will change. In fact, it is mid and small cap businesses that bring very high returns. Those portfolios that is having negative returns today will be the ones that is going to give very big returns. In fact, sometimes it is overextended too when markets go into a bull rally. Equity is an asset which needs time to work. In such an asset class, it is actually not good to look at returns and compare it in a short period like 1 or 2 years time, which will only bring distortion and fear in the investor's mind. Our country presently is going through a very big transformation phase where there is potential for multifold growth for investors who are in the financial assets. In fact, it is now right time to put more money into your equity side of your investments. Preferably mid and small cap space where investments made today has a potential to more than double in the next 5 years. So keep aside worries about negative returns that is in a short period and take advantage of the prevailing conditions that our country has to help your savings have very big growth. Thank you.